Most traders believe that the market is hunting their stop losses, but what if they've been lied to? The real force behind every sharp move isn't randomness or retail noise. It's institutional logic, smart money tactics that leave clear footprints. I built a strategy that taps directly into those moves. Then I turned it in a free indicator that automatically marks the zones in real time. No second guessing. I also created a custom script for strategy tester on TradingView to see how this setup performs in real market conditions. And now I'm going to break it all down step by step, how it works, why it works, and how you can start it using today with a free tool I have built. Let's get started. So I'm going to break it all down from liquidity grabs to structure shift and to entries. First of all, let's talk about strategy logic. Here is a three keys of this strategy. Step 1 is liquidity grab. A lot of people think that the market is hunting retail stop losses, but according to institutional analytics, retail trading volume makes up only around 5, 6 or 7% of the total market. Let me show you something more interesting. A lot of retail traders like to say the market is hunting for stops, but let's take a step back and look at the facts. Here is official data from the Bank for International Settlements. According to it, 48% of trading volume comes from institutional players like hedge funds and asset managers. Another 46% comes from dealers, including banks and market makers. And only 6% comes from non-financial customers, meaning retail traders. Now ask yourself, why would large institutionals or market makers spend time and resources hunting stops from a group that makes up just 6% of the volume? And finally, the market isn't moving just to grab retail stops, but we still pay attention to swing highs and lows, not because of retail, but because these are key structural levels where all types of participants place interests. It can be limit orders from big players, defense of positions, accumulation zones, exits or reversals. We use them as a reference points because that's often where price decides, are we continuing or we are reversing. Once that liquidity is absorbed, they can reverse the price to another liquidity or rebalance area. This is your first sign the market had its meal, it might be ready to shift. Step 2 is market structure shift. After liquidity grab, you'll often see the price break its internal structure that's called a market structure shift. And sometimes that's full reversal, other times it's just a retracement or a move toward a higher time frame target. So market structure shift is not confirmation, it's a trigger. It tells us that the market is ready to deliver from point A to point B. And step 3, fellow volume gap. When that shift happens, the market usually lives in a balance. These zones are magnets. Price often comes back to fill them, but not always. Price doesn't always pull back to this zone, and you can open a market order after a market structure shift. And right now, let's dive into more detail in every concept. First of all, which is liquidity grab. Liquidity grab is a market move where the price temporarily breaks through key levels, such as a significant high or low, to trigger clustered stop losses and pending orders. The main purpose of liquidity grab is to reach areas with a high concentration of orders, typically located just above swing high or just below swing lows. When the price breaks through these levels, it activates those orders, creating a brief surge in liquidity. This gives a large player the opportunity to execute big trades efficiently. It's important to understand how this appears on the chart. One of the most critical signs of real liquidity grab is when price breaks beyond the key swing high or low, but closes back inside the previous range. In other words, this is a breakout, but the price fails to hold above or below that level. This behavior indicates that the breakout was not genuine. Buyers or sellers couldn't maintain control, and the move was likely a manipulation to tap into hidden liquidity. Such setups often leave visible wicks on candles, particularly on higher volume, followed by a sharp reversal. You might also see a reversal pattern like pin bars, engulfing candles, or other signs of rejection. To correctly interpret these moves, traders need to watch for price breaking above or below a swing point, then quickly closing back inside. In this video we can see how price swept sell-side liquidity and about the risk-volume imbalance. After liquidation, price started to reverse it, and a few times later price reached imbalance zone. And now let's talk about fellow volume gap. This is your sniper zone. Fellow volume gap is an imbalance between supply and demand that occurs when the price moves rapidly, skipping the usual order filling process. It forms when there is a gap between three candles, meaning price doesn't return to retest the previous area. This gap indicates aggressive participation by large players, and the market often returns to fill this imbalance, but not always. In simple words, a fair volume gap is like a bus pacing a stop at full speed. People wanted to go in, but they didn't have a time. Later the bus turns around and returns to the stop to pick them up. Here is an example of how imbalance forms. Take a look, we have three candles. On the second candle you can see price shooting up sharply, and between the body of the first and third candle we can see this small empty space. This is called an imbalance, an area where the market didn't have time to properly trade, because price moved too fast. And during that move, many orders weren't filled, as price kept over them. After some time, price comes back to this zone to fill the unfilled orders, restore balance, and give institutional players a chance to add their position. After that, you'll often see the reversal in opposite direction. And this is example in our strategy. We can see here how price created liquidity grab. After that, we can see how price create market structure shift and imbalance. And a few times later, price returned to this zone to fill unfilled orders. And after this, we can see this reversal. Okay, let's clear up something a lot of traders get wrong. Let's talk about market structure shift. Market structure shift is a change in the direction of the market trend, signaling a potential reversal or shift in market pace. It is usually identified by a break in the sequence of highs and lows. For example, when price makes a higher high after a series of lower highs. This indicates the control is shifting from sellers to buyers. Honestly, for me, it's not trend reversal signal. So it's just price saying, I'm done with the previous flow, I'm ready to make a move, probably to a point of interest. In my scenario, market structure shift is a trigger on a lower time frame. It tells you that the price ready to move from point A to point B, for example, from LiquidityGrab to 5G on 4-hour time frame. You don't need to call the full trend, just catch the move between those key points. But if you want the confirmation of a major trend change, personally, I wait for a breakout structure on a higher time frame. And one of the most important questions, risk management. Let's talk profit taking where you get paid. First of all, if I don't know where to take profit, I pay attention to higher time frame levels, especially on equilibrium zone, which is 0.5 of premium discount range. The higher time frame equilibrium zone is an area of balance between supply and demand, where the price most often returns for a test or consolidation. That's why after impulse movements, the price tends to return to the equilibrium zone to collect liquidity and redistribute positions. Second, it can be high time frame levels. It can be order block or fair volume gap or supply and demand area on high time frame levels. It can be 1 hour, 4 hour or daily time frames. These levels provide context and targets for lower time frame setups. Logically, these levels are magnets and barriers for lower time frame moves. Third and fourth, all based on liquidity. It can be equal highs or equal lows. Session liquidity, especially London, New York Open, New York AM, PM or Asia. Price often reaches for this because it's great targets for exit. I can show you my settings every kill zone. First of all, which is time zone American, New York, and this is the time of every session. You can make a screenshot. And last, stop loss management. Where to place your stop loss. First of all, it's most popular beyond swing high or low. It's common and safe, but you may get tagged if there is liquidity sweep again. Second, you can put above or below the sweep wick with extra buffer. Reduces the chance of stop loss being hit on a second sweep, but also reduce risk-reward ratio. And third, you can put beyond the imbalance zone. If price moved impulsively, placing stop loss beyond the imbalance makes sense, but less likely to be respected. Higher risk of getting stop out. Logically, more distance, more protection, but less reward. Closer stop, better risk-reward ratio, but high chance of being hit. I understand all this seems to be understandable in theory, but as soon as you open the chart, it's hard to notice all this quickly, especially if you just started. So I decided to create indicator for TradingView, which shows all this automatically. It shows you right on the chart, where liquidity was taken, where a fair volume gap was formed, where there is market structure shift, and where is breakout structure shift happened. All of that shows up in real time, with labels and markers. So you just look at the chart and it's already mapped out for you. Basically, if you like the strategy, the indicator just makes it easier to use. The link in the description, add it to your TradingView charts, try it out, and let me know if you have any question in the comments. And finally, I have an indicator that shows liquidity grabs, market structure shift, and imbalance. I decided to turn it into basic strategy to see how it performs. Just a heads up, I'm not a pro, so there might be some mistakes in the logic. Let me explain how this strategy works. Let's say you want to open a long position. First, we need to see a bullish liquidity grab. That's a bullish SFP. Then the strategy looks for confirmation in the form of market structure shift to the upside. Once that happens, it automatically opens a trade. The stop loss is placed just below the last swing low, and the take profit is set at 2 risk-reward ratio. For short trades, it's the same logic but reverse. A bearish SFP, a break to the downside, and then the trade opens with a stop loss above the swing high. When I tested the strategy on different time frames, I noticed it works best when you look for liquidity sweep on higher time frames, like the 1 hour, 2 hour or 4 hour charts. Then you can look for confirmation on lower time frames to get more perceived entry. Let me show you some examples. Okay, first of all, let me produce trading plan. First, we need to identify liquidity grab on high time frame. It can be 1 hour, 4 hour or 2 hour chart. Second, we need to identify confirmation. It can be market structure shift plus inverted gap or imbalance. And our target can be equilibrium zone high time frame or fair volume gap on high time frame levels. And it can be liquidity, session liquidity, equal highs, equal lows, or swing high or swing low. Next, I start by making swing highs and swing lows on the chart. These levels often act as potential liquidity zones. And let's wait when price will slip one of the side of liquidity. You can see that after some time the price takes out the lower liquidity. This is sell side liquidity, but then closes back above that level. That's a strong signal to start watching for a potential shift. So let's watch on a lower time frame. Now I go into my indicator settings and enable market structure. This helps me identify any market structure shift clearly. I also turn on the fair volume gap to spot any key imbalance zones. Okay, once everything aligns with my trading plan, I open the order with a clear stop loss and target, based on the structure and fair volume gap. So it's good, take profit was achieved. Right now let's watch on another example. So in this example the price is currently inside a 1 hour imbalance zone. Let's first mark out the swing high and swing low and wait for one of the sides to be taken out. In this case, the price has taken out the sell side liquidity. Now it's time to move down to the lower time frames to look for signs of reversal. I'll keep the same indicator settings for consistency and convenience. And a few times later we can see that the price has formed a market structure shift. At this point I need to wait for a test to enter my trade. To help identify for potential pullback zone, I will use premium discount levels and VRP. This highlighted line mark as potential pullback zone, especially red and blue. Since all the conditions has been met, I can now enter the trade confidently, because all the rules of my setup are respected. And that's a wrap for today's video. Remember, success in trading takes time, discipline and the courage to keep going, even when you're confused. Don't give up, your future self will thank you. Make sure to check the description below to grab a free indicator and get access to all my socials. Stay focused, keep learning, and I will see you in the next video.